Joe and Brian, you guys are, our mentors in the self-storage side. You guys are also the co-GPs on this El Paso, Texas deal that we're doing. You guys are actually the whole reason that we got into self-storage. It was a year ago when we were at Brady's event. That's when, we got to meet Joe and hear Joe talk about, how he gave up on, he just fully, stopped doing single family flips and wholesaling like cold turkey. You just cut a cold turkey, you just go into self-storage. I still remember asking you that question. I was like, how did you get into this? Like, it sounds like you were very successful in what you were doing. How do you just give it up? And you said the only way to do it is just 2 feet in and dive right into it. So would you mind giving us a bit more background regarding what you guys were doing before self-storage?
Yeah, sure.
Yeah, what made you do the switch? So our audience can also understand a bit more about your background.
Yeah, absolutely. I'll kind of go first. I'll try not to speak for Brian too much because I tend to give my background and then I kind of suck him into it. So I'll let him speak after me. But yeah, I mean, I grew up in a family of contractors. My dad was GC and drywall guy turned general contractor, and my parents were divorced at a really young age. So like when I was a kid, that was nights and weekends for me, right? Like just driving around with my dad, checking on job sites. He was one of those guys that loved to work 8 days a week, and so it was just kind of in my blood from a really young age. And I just kind of grew to love it. I just always thought it was cool to be on job sites and see things get built and like watch stuff just come to fruition, like start with zero and turn into something, whether it was a kitchen renovation or an addition or a whole house being built. And all through high school, same type of thing. And always worked nights and weekends, with my dad and in some capacity in construction. And then, right after high school, was able to get into the U.S. Navy Seabees, which a lot of people haven't heard of, but it's the construction battalions of the Navy, and basically did construction. I was a builder in the Navy, flying around the world doing different types of construction projects. A lot of them kind of almost like big commercial-ish, what we're doing in self-storage, right? Pouring thousands of yards of concrete, laying block, all that type of stuff. And eventually worked my way out of the military and started doing real estate. Always kind of wanted to be an entrepreneur. My dad was the only entrepreneur I knew, and if you asked me when I was 10 what I wanted to do in my life, it would be take over his general contracting company. But when I got out of the Navy, we started flipping houses and kind of quickly, really kind of exceeded his GC company. They were our GC company for a while, flipping our houses. And then before you knew it, it was just like they couldn't keep up. So we ended up buying my dad's company from him. And Brian will tell that story, but that's kind of how he came along. I actually acquired Brian, even though I've known him since I was 9. He was actually working for my dad, and so he came on, became our COO, and we ran a very successful single family fix and flip business for about 12 years, and started to scale it up, and got to about 80 or 90 houses on our last year. And I remember looking at him and saying, like, what do you want to do next year? What do you want to do, this next, what's the next goal? What's the next milestone? What's the next rock? Are we going to do 120 houses, 100 houses? And he was like, dude, I don't ever want to do 80 again. And I was like, thank God you said that, because neither do I. Like, it was a nightmare. And, the reality of it was, guys, it was a great business, and, but it was a very, very difficult business. It was spread out along, probably a 100-mile radius around, southern New Jersey. So we were just getting to kind of the transition phase between single family and self-storage, right? Like, what were the pain points that kept us from, just staying in self-storage and scaling it? The reality was it's not a very easily scalable business. There's not a lot of people out there that are doing 200, 300, 400 single families a year. And if you do the math on that, let's just say a single family in our area was average 200,000. If you do 100 of them, it's 20 million. You do 200, it's 40 million. You do 300, you guys can do the math, right? How do you do $100 million worth of single family? Well, you better have a team of like 1,000 people, right? And so how do you do $100 million in self-storage? Well, I argue that you could probably have a team of about 10 to 15 people and do $100 million in self-storage development. Now, that sounds crazy, but as you guys know, after a year of kind of seeing what we're doing and behind the scenes of what happens and how you can do it, it takes time to build to that, but you absolutely can build to that. You absolutely can create that outcome. And you absolutely can create efficiencies around the processes to make that happen over the course of time. And so that's what we looked at, right? Brian and I were like, okay, well, we can take the leverage of the great core people we have. We can add a few more great people. We can start to find some great partners like yourselves. And we can start to leverage this amazing skill set that we have in construction, development, and processes. And we can start to partner with the right people and bring on the right people inside the business, and do it in a more efficient manner and profitable manner. And I think that that's what we've managed to build. Like I say to everybody, man, it's a work in progress. We're all fixing and creating as we go. We're always getting better. We're always solving problems. And I'll shut up after this, but going back to your point, Martin, I don't think there's a way that you can do what I just said without jumping both feet in the deep end and learning how to swim along the way, right? Because if we were still trying to flip 30, 40, 50, 60, 100 houses a year while we were trying to transition to self-storage, we wouldn't be here talking right now.
Yeah, no, for sure. And it sounds like basically on your flipping side, you felt like it's not necessarily like you were capped, but scaling was going to be much, much, much harder at that point. And it just made more sense for you to go towards storage because it's a lot more scalable. You can do much more volume and have, higher returns without having to build a team with thousands and thousands of people on it.
Listen, Brian and I both have some gray in our beards right now, but we would look like we were 80 years old if we kept flipping houses. The only way to scale that thing probably would have been to put me in my grave by the time I was 60, because it was extreme stress, extreme trials, it's just, you just can't, again, 50 employees, more than I ever want to have again. To get to scale in single family, I would need double, triple employees. I just don't want that. It's not the lifestyle I want. I want an amazing team of people that I love to grow with, that I can build, and this is important, legacy wealth with, right? I want people I can share the outcome with. We can share the upside. We can share the potential. Again, that's hard to do in single family. It's hard to share equity in single family. It's hard to build a portfolio in single family. In commercial, it's much easier play. And I want to bring people along and grow them with us.
I can only imagine how hard it was on a single family side. We did quite a few flips and nothing near what you guys have done, but I can't imagine doing 40, 50, or 80 a year. That's quite a bit of volume. But yeah, we're super glad you guys made that transition because that benefited us quite a bit, learning from you guys and working with you guys. So I think it's a pretty great story of how you guys got to this point. So let's dive a little deeper into the storage side.
Yeah. Well, Brian, what was it like for you from your perspective?
Yeah, so it wasn't much different. My family actually owned a lumber yard growing up, and the family rule was once you hit 10 years old, you went to work. So I got picked up from school every day, went to the lumber yard, I worked until they closed, worked every weekend, unless I was playing sports or something, and then stayed in the construction industry for the most part. Ended up, I think, at 20 years old, going to work for Joe's dad. And ultimately to the point where I was running that business. And as Joe mentioned, we were GCing most of his flips at the time. And he got to a point where he's like, look, I got to start my own business or buy you guys out. So he did, he bought his father out, which kind of, got him and I partnered up, and we really, took flipping houses to the next level. And to a level that neither one of us enjoyed. Ultimately, it was just so transactional, and you can imagine what payroll for 50 people looked like every week, and so on and so forth. It was just constant stress, constant, chasing after, the next closing, the next settlement, the next purchase, whatever, the next subcontractor to finish the job. It was just a nightmare. So, we knew that we couldn't do that forever. We knew we would burn out. We were probably close to burnout at that point. And, we just started looking at what's next, what's better. And, obviously the logical step was multifamily, right? Especially, back then, not that it's not hot now, but back then, everybody was talking about multifamily. And, I just kind of looked at it and said, yeah, it's better than single family. We like it. It's the next logical step, but it seemed somewhat oversaturated. Everybody was trying to do it. And, the more we research and started looking into things, you can have, an apartment building with 16 units, and maybe you have a complex of, 10 of those, and you have 160 tenants, but you have 160 tenants under 10 roofs with 160 toilets and 160 dishwashers and 160 refrigerators and air conditioning units. And then, we saw self-storage, and it's like, wait a second. I have 5 roofs and 700 tenants and 4 toilets. Like it was just so much easier, so much nicer, so much, from a management standpoint, so much easier. So it's so much more scalable. And, we had the construction skills, we have the construction background, and we said, okay, we got to figure this out because this is where we need to be. And, as Joe said, we shut down the flipping business and we jumped in with 2 feet and here we are.
It's funny, I feel like we both have the same kind of like origination story. We also got really frustrated from like the whole management part of multifamily. We actually did multifamily, built a portfolio with other people, got all the tenants and all the toilets. And we were just like, no, that's not what we want. We got like emails and calls from our property managers about mold issue and toilets leaking and stuff like that all the time. It wasn't something that we wanted to be involved in. And the more we grow it, the more the headache comes with it too.
Mm-hmm.
Yeah, and everybody I talk to in multifamily from every facet, whether you're a tenant, an owner, a manager, no one's happy.
No, that is
There's nobody happy in the multifamily business. So, I'm glad that we found self-storage and we went that route because it's been life-changing.
That's right. So here, I'm just gonna share my screen here to go over a quick deck that we put together. But this is usually what we show to our investors regarding the El Paso, Texas deal that we're doing. And obviously you guys are partners on this one. You guys were the one that funded the deal. You guys did a huge amount of due diligence on it already. And you also have your team, look at, make sure that this site has already checked all the boxes. So I would love to use this opportunity to also talk about, the storage syndicate team, the mastermind piece behind it too, but as well as, the amount of due diligence that we put into this deal. I think that would be a really good way for our audience to understand, what type of team you are, what type of company you guys are, and what we can do together. So this is the site that we have. It's 4 acres that you guys were able to identify through your team. And then we're having CubeSmart being the property manager. We're working with S3 partners, working with Barry Sherman to turn it into a Class A multi-story temperature control facility.
See, I think your acquisition process actually is if I can allow myself to say, but I think it's genius. I love how kind of you build that Monday.com platform and how you have all these people kind of join forces onto that acquisition process. Could you just tell us a little more about how that came to life and kind of maybe share with the audience kind of what your acquisition process looks like?
Sure. Yeah. I mean, I love you got a picture of the CFA deal board. So, I think, all the great processes come out of necessity, right? It's like a problem solving thing for us. We're always trying to solve problems. And so when it comes to finding great deals, it's all about risk mitigation, right? It's all about really taking and finding that proverbial needle in a haystack. And so what started out, even 3-4 years ago, we used to have to look through 300 to 400 deals to find one. Now that number is up to like 2,000, right? Like we have to really look through a lot of straw to find the needle. Like that, it's got to be sorted, it's got to be stacked, and we have to dig through a lot of stuff to find great sites. And so there's literally now probably a 200 plus point checklist that each one of these deals has to be run through. And just to give you some highlights, I mean, it starts with demographics, right? We have to make sure we have good income levels. We have to make sure we have good population levels. We're looking at competition. We're looking at rental rates in the competition area. We're looking at what's being built in the area. Then we're looking at zoning. Then we're looking at the piece of ground itself. What are the setbacks? What's the entitlements of the actual piece of ground? What can be built on the ground? And then it goes all the way through design. What can be designed? What do the unit mixes look like? We're doing feasibility studies. And so it gets deeper and deeper and deeper down the rabbit hole the longer that we're investigating that piece of property, right? And so that process takes anywhere between 6 and 9 months to a year, depending on which site. And so Brian could probably tell you when we probably originally locked this site up, but I guarantee it's been more than 6 to 9 months, right, Brian? Probably last fall.
Yeah, so we actually we locked this property up, I want to say, over a year ago, and actually couldn't get through all of our due diligence. We couldn't get answers. This particular property we had, it does not currently have utilities on it. So, we have to run utilities from the intersection. We had to get an easement to do that from the neighbor. And, now we're at a point where we know we can get utilities on this building and we know how much it's going to cost us and what that process looks like. But, a year plus ago, we couldn't figure that out. We couldn't get all the answers. The township wasn't being forthcoming. There was, call this department, call that department. We just couldn't get it nailed down in time. So this property actually fell out of contract. We walked away from it. And then, finally they reached out and they're like, hey, we finally got some answers. And that we kind of re-engaged at that point and verified everything and made sure that we could build what we want to build here. And went along furthering through our process and make sure we were able to check all those boxes.
I think that the takeaway here, though, and the important part is that, we love to go the extra mile, because what do most investors do is, they quit, when it gets a little bit difficult. And so the more difficult it is to approve or check all those boxes, the more people are going to fall off and fall to the wayside and not want to invest the time and money, frankly. It costs, well over six figures most of the time to get these things to the point where an investor is ever taking a look at a deck like this, or there's ever marketing put behind it, or a joint venture partners ever being, talked to about a deal like this. So there's literally thousands of hours. There's multiple teams. There's much research being done. There's designers, there's engineers, there's, feasibility reports, there's bankers. So many folks are looking and underwriting this deal. It's not just as if, like back in the single family days, Brian and Joe would go walk a house and walk out of there and go, yeah, we get, $35,000 budget. That'll do it. Let's make an offer. We'll close in 7 days. Now it's literally, dozens and dozens of professionals who have to put their stamp of approval on a project like this long before it ever sees, a fancy PowerPoint deck like this and gets in front of an investor.
That's right. And when you guys presented this to us, we love the fact that, El Paso, Texas, we actually live in Henderson, Nevada. So El Paso, Texas is one of the safest large city in America. And also
surprising to us because it's a border city. We thought, there might be some crime there, but they have one of the largest military base in El Paso. And there's a lot of, border security, border patrol. There's a lot of authority presence there. So realize it's actually probably it is one of the safest, but there was really nothing to be worried about out there.
We also love the fact that, natural disasters, right? I know you guys are doing deals in Florida. As Canadians, like tornadoes and hurricanes just freak us out. So the fact that it's a desert, nothing really happens down there in terms of natural disasters, which we love. But most importantly, if you look at all the self-storage KPIs, we love the fact that, the saturation it's definitely extremely low. It's very favorable for us to develop there. I think there's an excess demand of 700,000 square foot of unmet self-storage square foot that needs to be built, but we're only building about 84,000 square foot. So technically, if 10 other facilities and operators open up a brand new Class A self-storage facility, we're barely meeting that demand. So I think that's what's really attractive about the site for us. And that's why, we think it's definitely worth it, right? to put in the due diligence and to wait. But just as a comparison, this is what, just another site that we looked at in Houston, Texas. You're dealing with 16 other competitors versus in El Paso, in the 3-mile radius, we only have 2 other competitors sitting at 100% occupancy.
But it's also
and an almost identical population, by the way, just to point that out, right? So, again, 16 stores with 65,000 people, 2 stores and 56,000 people. So it's crazy.
And it goes back to what you were saying, right? Like, I feel like, and at least for us, based on, all of our research and everything that we've been doing, I feel like finding the right lot is the most important part, but also the hardest part, because there's so many criteria, there's so many boxes you have to check, there's so many things you have to look at any point during your research. It can meet all of your boxes to a certain point, and then it doesn't meet this one, well, we have to drop it. And all the time and money that we put into it, well, it's just gone, but it's just part of it. We just gotta keep doing it again until we find the right site.
True.
Yeah. And part of, our power team, and also through being part of your storage syndicate program, we had the pleasure of meeting Barry Sherman. Would you be able to shed some light on, how Barry is going to be involved in this project and how you guys came about in working together and joining forces?
I'll leave that one on Brian. Brian talks to Barry every day.
Yeah, every day, all day, multiple times a day. So, Barry's yes, he's a consultant, but we internally here, he's our chief development officer. He's got decades of time in this business. He started as an architect right out of school, and then he started designing these buildings. Then he opened up his own GC company and started building these buildings. Then he started developing these things for himself, sold off the GC company, got out of the architecture role, and he's been, developing for a couple of decades now. I think he's had a hand in something like 350 projects, just self-storage over the years. So, he's kind of a who's who in the industry. He's been able to make all the great connections for us and give us some really good insight into not only ourselves and how we should build something, but some of the other partners we should be using and talking to, and all the way from third party feasibility people to banking relationships, GC relationships, civil engineering relationships, and he kind of it's kind of funny. We call him the Enigma, but he's kind of more like the Wizard of Oz. He's sitting back there and he's pulling all the handles and he's kind of quarterbacking everything from his role, and just making sure all the trains run on time. And obviously, Joe and I and Martin and Lynn, and we're all involved in this process and making the decisions that need to be made. But we definitely rely on his experience, and he's helped us gain the experience that we have so far in this industry.
Yeah, absolutely. And the timeline in terms of the construction, our investors and us, we really appreciate the detailed breakdown of it, right down to the dollar amount. And this is, I believe, one of the projects you recently completed in New Jersey. We essentially just got these photos of your Facebook post. And would you be able to tell us a bit more about the projects that you recently opened up? I know you had a project in New Jersey, one in Ohio, and another one in San Antonio, Texas. Just going through a few photos here.
Yeah, tell us more about these projects.
Yeah, this one you're looking at is done. So these pictures are probably a year old, but yeah, this one's all complete. We're actually there's the grand opening photo, as a matter of fact. So and the photo on the left is there's all the asphalt where all that dirt was in the previous photos. This is about 100,000 square foot net rentable facility. You guys can see just kind of how the layout works. It's all drive up garage doors on the lower side, and then we have a 3-story climate controlled facility on the upper side. We're standing in front of obviously the office there, and this site right now currently, what do we have, about 26% occupied, Brian? I think we're four plus months into the ramp up. So it's going along really well. It's a CubeSmart managed facility. Obviously, you guys can tell by the photos, but these guys are doing a great job, and we're very happy with the progress.
Yeah. So that's exactly, we're essentially copy pasting the model into our El Paso, Texas project, because CubeSmart also has a large footprint in El Paso, Texas as well. And for our site, they were actually able to deliver a lease up revenue projection and the lease up velocity of how fast it's going to take to lease up, all of the units that we're projecting to build. And the fact that, we're working with CubeSmart, we get to leverage the SEO, we get to leverage their paid ads. If you Google self-storage near me, you're not going to see Martin and Lynn self-storage on there. You're only going to see REITs, right? So that's a huge benefit of working with them. And the fact that we can tap into their existing infrastructure, both online and also offline. The fact that on their website, even if it says, El Paso self-storage, it doesn't necessarily mean they own them. It's just they're the property managers. So we absolutely love the fact that, we get to leverage that.
I mean, I'd love to see, because you guys work a lot with CubeSmart just in general. Like, what's the thought process of going with them rather than going with another, company that does management like Extra Space or Live Storage?
So, yeah, we do have a facility that's about to open up next month. That's going to be a Life Storage, just to try to, quite frankly, that facility is in Life Storage's backyard. Everything up that way is where Life Storage came from. It's up in New York near Buffalo, where Life Storage originated. So they're like the local favorite, and that's why we're bringing them in. And quite honestly, I want to bring them in to compare and see how we are against, CubeSmart. That being said, I think the thing that I like best about CubeSmart is the fact that, they're based out of, I think, Malvern, PA, which is about 45 minutes from where I'm sitting right now. We have a great relationship with their vice president of third-party management. I have a cell phone number. I talk to them 2, 3, 4 times a week on various different projects, and just having that closeness and that availability. I'm not going to say that other management companies don't give you that or can't provide you that. But I mean, so far, CubeSmart's done nothing to nothing to make me look elsewhere. They've been super responsive. Like I said, to being able to, just pick up the phone and shoot a text or shoot a call and get an answer almost immediately is huge for me. I hate when people say I'm waiting to hear back from this, I'm waiting to hear back from that. I'm the type of person that wants answers right then and now, and being able to get that through CubeSmart's been a game changer for me.
Awesome.
Absolutely. We also love the fact that, because we're in this asset type, we always show people this, to turn a unit that's, essentially tenants stop paying rent, and we have to send their stuff into auction, turn it into something that's rent ready, take 30 minutes. However, in multifamily, it takes at least 3 weeks, or honestly, 3 weeks is really being very
depending on
optimistic
the
here.
state of that unit. We've got renovations that took way more than that because the house just was a complete redo. Like there was mold in the walls and insulation was moldy. You got to tear all that down, and then you realize there's not been tube behind the walls, and you have to rewire the entire unit. So yeah, it's just feels like such a relief to know that you're never gonna have to deal with that again. I don't know how you guys feel, but I'm pretty happy about that.
I feel like I'm stealing some of your slides after this presentation. It's just good stuff.
Yeah.
I think.
Yeah.
Help yourselves.
See, what's funny about this picture, that was actually the first time we rented a self-storage unit. And that was because apparently in Canada, if you kick out a tenant, you're responsible for their belongings.
Yeah, you can't just get rid of them. You have to put them into storage and to come and take them.
So we're dealing with, I don't know if you can see, we're dealing with bungs, crack pipes, needles all across the floor. We have to hire someone to pack all that up and put it in the self-storage unit.
That's true in America too, in a lot of places.
Yeah, we dealt with that here as well. Yeah.
So in terms of the exit strategy, we'd love to talk a bit more about the exit strategy that you have, and also that we're planning to have for El Paso. And we can make sure we spend some time on the storage syndicate mastermind too. So in terms of the exit strategy, the fact that we can sell it as a piece of entitled land, which I know you guys have done before too, you can sell it as CO, where you can sell it as stabilization.
What do you guys see as because I know a lot of the projects that you're working on you've gone all the way to building it at least. What's your, I don't want to say preferred, because I'm guessing each project is different. It's really a matter of can yield you the highest return. But what do you guys go in mind? What kind of exit strategy do you have in mind when you start a project, and how does that change if it does?
Yeah, so a lot of people don't believe me when I say this, but I'm really agnostic about the outcome, right? It's what's best at the moment and what's profitable, right? Nobody has a crystal ball. Give you an example. Brian and I are selling a piece of entitled land that we've owned for a year and a half. It took a long time to get permits. The local area got hit by a hurricane. The local municipality didn't answer our calls for 9 months. We finally got permits on the property, and now another motivated developer comes along and wants to buy it and wants to give us a profitable number for it. We're going to sell it, right? Like for us, why hold on to that asset for longer and try to develop it when it's already been, a year and a half? If we're going to make a profit, we can move on to another one. So, you're listing all of potential outcomes, but my point is, I think we should also always be open to outcomes. If we're halfway through construction and somebody comes along and says, I want to give you a huge profit for you and your investors, what are we going to say? No, we're building it. Go away. There's always going to be opportunity. And so what we need to do as good GPs and as good owners is decide at what point in time is there a great outcome to be had, and how do we go about that? And that's really, I think, what our investors, want for us, is to make sure that we're being good stewards of the asset and make sure that we're doing the best thing we can to create a good return. Again, nobody has a crystal ball. Maybe you made 18% and you could have made 20. I'm still pretty happy with 18. So again, I don't know any of us has a crystal ball of when the perfect time is. You're never gonna find that perfect time, right? The goal is to have a great outcome for everybody and then go do it again. That's just my personal opinion, but this is your project. So, again, that's maybe your question.
I love that you're saying that, because we got Roderick, and Roderick is a member of our team on specifically for that reason, because we call him the freak in the sheets. He's really, really good with Excel sheets. He's like built the entire financial model, all the projections. He's able, if we call him today and tell him, hey, change your model and make it as if we're selling a year two, and it's, half built and we've put in X amount in construction, he can tell you exactly what the annual return is going to be, what the total return, the IRR is. And that's really kind of like our main goal is really to make as much money as possible for investors, to make sure we have like a good return. And that, we have to factor time, we have to factor how much money we've already put into it, we have to factor all of those things. So we're constantly ready to go in and change that model, to change our underwriting and see how that looks like for our investors. And really our main goal is just to get our investors as much returns as possible. So I think we're really with you on that front.
Yeah.
We also love the fact that I feel like, you can definitely agree to this too. I told my designer to put this in the simplest form possible. We just love the fact that, as an exit strategy, we have different points of exit, sure, but the pool of buyers that we have. So we are dealing with, we can be in and out by a big fish, right? We're just a tiny little fish in the market. And we're dealing with all these, Blackstones of the world, the REITs, the private equity groups, the family offices. They're looking for either a stabilized asset, or they're looking for asset to build onto for market consolidation. But at the same time, the way that we're positioned is so I'm more upset about the institution buyout. So we're looking at over the past 20 years, the private investors are selling off their portfolio, as I said, to REITs, to private equity groups, to institutional investors. And that's where we're seeing Life Storage got sold to Extra Space. Public Storage is out here, obviously buying portfolios after portfolios. Manhattan Mini Storage sold for $3 billion for its 18 locations. Blackstone is getting into the game. Bill Gates is getting into the game. But at the same time, the fact that, all the smaller fishes, like all the brand new developers that are trying to get into self-storage, they're also constantly chasing after us too. They are willing to pick up a piece of entitled land. And that's exactly what, who you guys are selling some of your projects to. Are developers that are never even been in self-storage, but they understand it's way easier, it's way better compared to what they were doing before, and they're trying to get into it. So I think the fact that we're considered a mid-size, the fact that we're mid-size is because we're leveraging your guys' experience, is that, we can really benefit from two pools of buyers. And that's what we absolutely value, being the fact that, that's our exit strategy.
Yeah, love it.
Martin just wanted to put fish in his presentation. I don't know why. I think that was the point.
But yeah.
But again, something that maybe didn't need to be said or goes without saying, but the reason all those big players are buying up all the little fish is because self-storage in its history is the best performing asset class in all of commercial real estate. Historically speaking, it beats retail, it beats multifamily, it beats, commercial, it beats everything. And that's why all the big money is flowing into this asset class.
Yeah.
You can also see it during the last recession. It was the only real estate asset type that was still yielding a positive return even in 2008. So it's honestly, the numbers speak by themselves.
Yeah. But just looking at a deal at a high level, we're looking at, year 3, we're able to create about net operating income of over $1 million. And again, we didn't come up with the number ourselves. It's coming from a feasibility study, as well as the CubeSmart revenue projection. So we're playing our scenarios at worst, conservative, and likely scenario. And that's obviously based on the cap rate. And this is assuming that we sell at stabilization. So we're looking at, 6% cap all the way down to 4.5 cap. And we're looking at a valuation anywhere from 17.3 to just over $23 million. But again, we're building this for, just under $14 million. So that gives us and our investors quite a bit of equity that we get to play with.
So what are you guys, you've been doing this for longer than we have. What are you seeing in terms of cap rate? How is it changing? What are you seeing is being sold for? Just kind of your personal experience with that.
Yeah, so in 2022, the average cap rate, I think is an important fact to understand. In the average cap rate in 2022, now, arguably the rates started going up in June of 2022, I think, Brian? That was the first rate hike. So there was
Yeah.
3 rate hikes in June of 2022. And still the average of the entire year in Class A self-storage, guys, was 4.6%. Right. So that's with 3 rate hikes, 4.6%. Now, so figure, 5% could be where we land, right? So even on your chart here, you're between conservative and likely. So call it $21 million. That's a pretty good ROI on a $13.7 million build. Call it 14 million. Rough numbers. You guys are talking about a $7 million profit margin on a project. That's kind of what we're seeing. People are trying to figure out rates. They're trying to figure out where things are going to stabilize. They're going to figure out what their banking costs are and things like that. But I think that's where you're going to see things start to land, somewhere between that 4.5 and 5 range on the cap rate scale.
See, we really like that spread, the difference between how much it costs you to build it versus how much is going to be evaluated. And a lot of people actually here are more on the multifamily side, and they're probably more used to building multifamily, and they don't see numbers like this. Could you just quickly go through, why is it so low for us to build it, and how come we have so much spread in between those two numbers?
So, I kind of alluded to it earlier, but there's 4 toilets. There's 5 rooms. There's, we're not putting kitchens in here. We're not putting bathrooms. We're not high finishes. These are steel and concrete with some LED lights. The operational cost is low. The management cost is relatively low compared to a $14 million multifamily asset. It's just, it's very basic. Like, this is not sexy at all. This is just, the numbers are sexy, right? The building, the development, no one's in there picking tile, no one's picking out flooring and carpet, and it's plain, it's vanilla, it's LED, and run right, it's super profitable. And at the same time, there's a huge demand. We live in a country here where people just don't throw things away. You went back to that slide and showed that first house that you built full of stuff. People don't throw stuff away. They'll go in and they'll rent a unit to store their stuff and not look at it for 5 years. Never go back. Forget that they even own it, but they pay that bill every single month. So for that, yeah, it's crazy. It's I don't know.
Give you guys another great analogy, right? That picture you showed with that full apartment on a make ready took you 3 weeks to do a make ready, right? What did something like that rent for per month?
That specific unit is currently rented for 13.
13. Okay.
Yeah.
1,300 a month, right?
Yeah.
What's a make ready cost you of 3 weeks of make ready? You got to repaint the whole thing, put new carpets in, they mess up the kitchen counters. What's it cost you to do a make ready? It's a month long.
That one specifically?
That one specifically, we spent a lot.
Yeah.
That one's
$5,000, $10,000. Just
way more than that. And that actually took way more than 3 weeks. So that was honestly very optimistic.
In average, maybe like $5,000 to $6,000. I would say for something light, that would be our average. That specific unit is was its own thing.
But it cost you 5 months of holding costs, right? 5 months of rent to do one make ready for one tenant.
Yeah.
Right. If somebody leaves all of their stuff, and even if you have to go through the auction process and you're still going in with a broom when it's all done and sweeping out the unit, that's a make ready.
It's true.
Right. That's the difference, guys. Right. Like, I'm not telling it to you because you know this, I'm telling it to the viewers, but the reality of it is, like, you can't really damage these units. They're metal and concrete. I'm not replacing countertops and painting walls and putting new trim up, and the pet stained the floor and I got to rip up the floor and put down new flooring. Like, it's concrete, so it's relatively bulletproof.
It's also like people are not going to go into these storage units, examining the walls, making sure that there's, no dents, nothing. They're not going to be as picky as they are when it comes to multifamily. If someone's live in that space, they're going to have high standards. They're going to want to make sure everything is perfect. And they will call you every single time there was an issue with the unit. With storage facilities, I just can't imagine what issue they would have. Just go into the unit one day, realize they don't like the lighting or the color of the metal is not good enough. So it's much easier with self-storage.
Yeah. And obviously, to turn it into a reality, we're going with the syndication model. I understand that you guys have a fund, but the syndication that we're planning to do, this is obviously what it looks like. So we're working with you guys, we're working with Barry. And who we're essentially actively operating the asset, executing a business plan. We're contributing the expertise that we have and also you guys have. That's why we're leveraging your team. we're contributing our own capital. We're dumping a lot of our own money into this. You guys have dumped so much money into this as well. And obviously in return, we get equity and fees. Now, for our limited partners, they get to passively contribute capital. They get to receive the preferred rate of return even before we get paid. So the first 8% is paid out to our investors, plus the equity, plus the dividends, and they're protected from the liabilities. Let's say if someone were to sue our site because they slip and fall, our investors are not going to be affected from that because they're fully protected. Now, understand that you guys did this over and over again, and you also proceeded to start a fund. Could you tell us a bit more about the fund, the $50 million fund that you guys have? And the fact that I think the minimum buy-in for you guys is about $250,000. So could you give us some rationale behind that decision?
Yeah, it goes back to really the beginning of our story, right? So we've done this 9 times, the exact way you guys are doing it. We raised roughly the same amount, between 3 and 5 million for each deal. We did it on individual shares. I mean, virtually the same way you guys are doing it, right? I mean, it's the concept that we've gone over with you. And the fund is really the scalability of it. It's the next level. It's now how do we do the next 10 to 15 deals under one heading, and pull the investors' money together so that we can do deals in a more quicker succession. Because we already talked about the underwriting process, the team, where the deals are being found. And so this just allows us more of again, scalability, to be able to have the money available. So when the deals are ready, we can close, and there's just no lag, there's no delay. We've kind of proven the model works. Now it's a matter of how do we start to scale and do more of them, and then allows us to obviously, not only Legacy does more deals, more joint ventures can get access to deals and things like that. So the fund is actually a $250 minimum buy-in, and it's open.
Awesome. And here, I'll just touch on this real quick. So whenever I want to explain this, Linus, I don't explain this. But I love the fact that,
It's okay. I think maybe you guys might have an easier way of explaining it. I just feel like this is a kind of, a lot of our investors are not used to a waterfall structure. So we always try to explain it to make it as easy as possible for them to get it. But you guys might be able to explain it better.
But this is how we're structuring the deal, right? It's 8% pref, 70-30 LP-GP split. So obviously favoring the LPs. And we're also introducing a second hurdle at 18%. And that's where we essentially get to make a little more. So 60-40. But again, 60 favoring the LPs. So as soon as we have a sale event, in this scenario, the principal payback happens first. So let's say investor invests $200,000, they get their $200,000 back first. And from the 0 to 8%, that's what we call the preferred rate of return. So they get their first 8% back before anyone else even makes any money. So none of the GPs make any dollar until the first 8% is hit, because the first 8% goes straight to the limited partners. Now, from 8% to 18%, that's where we have a 70-30 split. And anything after 18%, that's where, essentially we're so confident in the deal that it's going to generate over 18%. We're essentially introducing a second hurdle rate that will hold all of the GPs accountable to make sure that, the deal overperforms, because that's the leverage that we have to make more money from this deal.
And that's the waterfall structure.
Yeah, and if I could jump in here real quick, you can see where our thought process is. Yes, we're developing a great asset that's going to bring great returns, but our responsibility here as GPs is to the LPs, right? LPs are getting the principal back first, they're getting their pref first, and then they're getting a majority of the first split, and then still a majority of even the second split. So the whole time along this deal, it's LPs first, because ultimately, these things take a lot of capital. And if we're going to do a lot of these, we need happy investors. So our goal here is to, treat the limited partners first, make sure they make a great return, and hopefully they reinvest that return on the next one.
Yeah, you're totally right.
Yeah. So definitely would love to spend some time to talk about Storage Syndicate, the mastermind that you guys have as well. But for our viewers, who are interested to learn more, we're gonna have Joe and Brian's contact. We're gonna share that as well. But here's Martin and Lynn's contact, and if you scan the QR code, you'll be added into future webinars that we have and future deals that we have, and with Legacy as well. So love to take some time and talk about Storage Syndicate, because that's the reason, we even got to know you guys. That's the reason that we're doing this deal together. For our viewers who are, looking to more than just, invest passively as an LP, if they're looking to do their own deal and trying to learn more about self-storage, we personally found, joining the Mastermind, it gave us a lot of clarity. We even participated in the CFA program, the Certified Field Agent program, just to understand how you guys look at deals, to understand the process that you guys have. But would you be able to shed a little more light on, the thinking behind creating a Mastermind and the community that you guys have built?
Yeah, I mean, I keep it brief. I mean, the Storage Syndicate is really an exclusive, very tight-knit group of people like Martin and Lynn. It's the whole concept is really, creating, Brian and I can only build so many deals together. So, we want to find great operators that want to get into Class A developments like this, and are looking for kind of the roadmap and the blueprint, and not just like business in a box, but like literally, hold their hand and mentor them through the process, access to our teams, access to our designers, access to, everything you guys just saw, our crews, our subcontractors, our bids, our contracts, everything, and so, I really foresee it never really being a massive group, 20, 30, 40 people. I think we kind of did a pivot recently where at one point we wanted to have a lot of people, and I started to realize, like, I really want a lot of people, right? I really want an exclusive group of people that are going to go out and do deals, not just tire kickers that are going to think about doing deals and then, make excuses as to why they couldn't. I want committed people that really want to, take deals across the finish line, kind of like I said, Martin and Lynn are doing. So to me, that's what it's all about. It's about doing deals together, helping each other win and succeed together. It's not about being greedy. To me, I'd rather have a small percentage of the watermelon than 100% of the grape. We've talked about this a long time. And getting really, really good Class A deals across the finish line so that we can all build together and create legacy wealth. I mean, that's really the commonality that we all have. And I think we all have an abundance mentality. Like, let's go out there and win together, and let's create good opportunities.
Yeah, I love it. You couldn't have said it better. I want to kind of open it up for people if they have any questions to be added into the chat. We're kind of coming to the end of this webinar. I think it was great. I really enjoyed the conversation. That was super informational, but I really want to open it up for Q&As. Any questions that you guys have, you can add them in the chat, and we'll make sure that Joe and Brian answer all of them. I can start. I actually do have a question. Do you have a question, Martin?
Go ahead. No.
I have a question. So you guys have transitioned from single family houses and flipping towards your self-storage projects. You're growing your company, you're working on different developments. Where are you guys heading with this? Is it going to be storage forever from now on, or do you have any other projects you want to take on after that? Where are you going with all this?
I can answer myself. Brian might have a different. I'm laser focused on storage. I want 100 deals in 10 years. That's it. That's all I'm focused on. I will do a handful of coaching on the side. That is really it. It's 99% storage.
Yeah, it's funny. Every time I get asked that question, our goals are aligned, same goals. We're focused towards storage, 100 deals in the next 10 years. And then people go, then what? What's the next 10 years? And quite frankly, my answer is whatever I want. You know what I mean? If we're able to, complete, you see what these numbers look like and what these cap rates look like. If we own 100 facilities in 10 years, there's not going to be much that I can't do. So, laser focused, meeting our goal, and then we'll figure out the next goal when this one's met.
Love it.
How has it, because we all talked about almost like mental health, that, all the distress that we have to deal with when we're doing single family. What is it like for you guys now? How is your family life, now that you're doing storage? Do you see a drastic change in terms of how how much time you get to spend with your family?
It's kind of linear balance. Yeah.
Drastic. I know Brian can answer this because Brian used to work 27 hours a day. So I know. Yeah.
No, it's definitely a drastic change. And quite frankly, I never really, I never equated it to switching to storage, although it's probably 80% of the factor. I always kind of equated it to, being a little older, a little wiser, appreciating my time a little bit better. But being in storage versus, doing 80, 100 flips a year allows me that time to spend with the family and that freedom to really enjoy them rather than just, you know, come home at 9 o'clock at night and pass out and wake up at 4 o'clock in the morning and do it again, you know? So, yeah, it's definitely been better. Not necessarily easier, but better.
Yeah. I was gonna throw a little asterisk on that. It's still hard work, guys.
Yeah.
So like if you're watching this from the, you know, it's still hard work. Like we're still solving problems every day. We're still, you know, trying to, you know, create, you know, solutions and, you know, figure things out. It, you know, like I said earlier, we're fixing problems every single day. That's business. That's life. That's like, you're not going to learn if you're not growing, but it's way easier than it was in the single family world, in my opinion.
It's funny you were asking that. As he was asking that, I just remembered, like, we used to work all day on all of the projects that we were working on and doing all the stuff we used to do on computer. And then at night, we would just drive around to every single renovation project that we had going on. And I just remembered the next morning, what I have to do is call the contractors and give them shit for the work they haven't done yet and tell them what's going on. And you keep doing it over and over again every night. And
yeah, Lynn was describing date night for us. So that's what but
sounds romantic.
Yeah, that's right.
Yeah.
Before we end the call, would you guys have anything else that you would like to share, either with the live audience and also with you know, the audience that's watching a replay?
No, I think it's a great project. I'm super excited that it's your first you know, jump into this thing, because I think that it's going to set you guys up for success. Any investors that are on the fence and want to get into this thing, you know, the year I've spent with you guys, I'm super impressed. You know, just this presentation, I'm impressed. Guys, we've done this. Understand this will be, I think, our 13th project we're closing, Brian. I think 13 or 14th. That might be one of the best presentations I've ever seen or done in the last 4 years of doing this. So like, I'm very impressed with the two of you.
I appreciate
I'm
it.
super excited with the team you've put together. I'm really excited to see you guys get this thing out of the ground. You know, just knowing a little bit I know about you guys in the last year or so, I think you're going to end up breaking ground quicker than some of our joint ventures that closed last year. So like, I just know that you guys are nutty about it, and I'm excited to see you win, and I'm excited to see you go out there and do it. So any investors that want to get in this, they should definitely jump on board, and I'm confident in you guys being successful.
I appreciate it. And then lastly, where can guys reach out to you if they want to, you know, learn more about what you're doing, if they want to inquire more about the mastermind that you guys have? Where can they find you? How can they get in contact with you guys?
I'm easy to find. They can go on Facebook, LinkedIn, type in Joe Evangelisti. I'll pop right up. So same with Brian.
Yeah. If you're looking for me, type in Joe Evangelisti, you'll get them.
Awesome. We'll add your contacts as well in the information section. But I really do appreciate you guys taking the time to do this with us. This was really, really fun for us. I hope that people on the call here also enjoyed this and get some of their questions answered as well. But yeah, no, thank you so much, guys. And you know, let's do it again when this is finished.
Yeah.
You know, when this project is done, we can do it again and do a review of how the project went.
Yeah, next
I think that'll be great.
Oh, absolutely. Yeah.
Will do. Good work.
Awesome.
Thanks,
Thanks.
guys.
Thank you guys.
Bye-bye.